Hi, everyone, and welcome to episode 36 of the Civics Project. I'm Beth Rebay, the host of the Civics Project and the Director of Repair, which is the sponsor of the Civics Project. You've joined us today for episode 36 on taxation. Before we begin, I'd like to share a brief land acknowledgement. Repair acknowledges the Tongva peoples as the traditional land caretakers of Tovangar, the Los Angeles Basin and South Channel Islands. And we are grateful to have the opportunity to work for the Taraha Tone, the indigenous peoples in this place. We pay our respects to Hanuk-Vatam, the ancestors, Ahihiram, the elders, and Eohinkam, our relatives and relations, past, present, and emerging. If you'd like to join us for our next episode on November 7th, episode 37 will focus on the minimum wage. And we'll be back on Sunday, November 14th for our session on the Violence Against Women Act. And we meet each Sunday at 2 o'clock Pacific time, 5 o'clock Eastern time. So to begin, 62% of the US public says that our tax system is not that fair or equitable. Some say it's very unfair. And this data primarily reflects the public sense that we pay more out in taxes than comes back to us in things that government does for us. Notwithstanding this substantial level of public dissatisfaction, most people don't have a clear sense of how our very dense, often changing and structurally complex tax systems work. Before we try to unpack just a couple things of how it works today, and please understand that I'm not going to try today to explicate a full 101 to the US tax system and wouldn't necessarily even be qualified to do so. But I do want to just think about the meaning of taxation in public consciousness in the United States historically. Some of us have heard the slogan, "No taxation without representation," associated with the Revolutionary War period. Which led to the founding of the United States. And one of the reasons that taxes were part of the focus at the time was that there was significant levels of taxation of the colonists by the British Empire and sometimes by other Western European countries, but around the Revolutionary War period by the British Empire. And nevertheless, even the most elite of the US colonists had very little voice in the British Empire. So the basic idea is you pay taxes, but you have no power about how that money is spent, and it basically just goes to enrich others and doesn't come back to you. So rebellion against unfair taxation has been built into the ideologies, the mythos of US society since at least the 18th century, if not before, in colonial periods. In essence, taxation has been associated with tyranny historically. So it's not necessarily true that people find taxes tyrannical today, but we can note the fact that the majority of the public still feels unfairly taxed, in part relative to that historical context. I want to talk about a little bit about how our federal taxation system works. And again, I want to stress that this is not even a 101 or primer because it's a deeply complex system, only some of which I would even have enough familiarity with to lecture about. Our federal taxation system focuses primarily on taxing income, whether corporate or personal, but some federal and municipal and state governments can also have taxes associated with sales or use, and of course things like import and export. And these kinds of taxes would focus more on adding a fee to various types of expenditures. So it can be goods-based, activity-based, or income-based. Part of the public perception today that our system is unfair likely bears on tax loopholes. These are various provisions and mechanisms that allow people to accumulate significant wealth without being subject to taxation at any significant or comparable level. One of the most significant of these loopholes is what is termed capital gain. Capital gain is essentially the profit derived from selling something. So it could be property, could be stock, could be a business interest. And the profit is basically, the tax is paid on whatever it is that you made relative to what it originally cost you or how it was valued when you acquired it. As long as the asset has been held for at least a year, it's considered a long-term gain. So once you've owned something for 1 year, it's a long-term gain, and it's subject to lower tax rates than many other forms of income. So for instance, while we could be taxed as much as 37% at the highest level on our wages and salaries, long-term capital gains are never taxed more than 20%, and it may be substantially less. So often somewhere around 2/3 to half the money that you would spend or that you would have to pay for other kinds of income paid on capital gains. Just to give you a sense of why this matters, for the very rich, and I would define that here as people making more than 10 million per year in annual income alone, not just accumulated wealth. Most of the income reported on tax returns is from capital gains or from things like stock dividends, both of which enjoy preferential low tax rates compared to other forms of income. So furthermore, while with our salaries, we pay taxes as we go, taxes and assets are not charged until the assets are sold. So if you make $100,000 at a job, you're going to pay taxes as you go through paycheck withholding, and then basically within a year on your federal income tax return and state income tax returns. And the government will get money from you fairly quickly, if not instantaneously, as you earn it. But with a capital gain, a person can basically delay paying any taxes for years as long as they're not selling what they've made a profit on. And there are additional loopholes that also can help you if you do need to sell. So for instance, you can try, if you've lost value in something else you have, then you can sell something of value to sort of basically balance out the taxes. In other words, you can claim the loss against your profit so that you don't have to pay as much taxes or any, in some instances, on what you made a profit on. So there are different ways to get out of paying capital gains tax even when you sell something of value. And another major one is inheritance. And we have a loophole known as stepped up basis. And this basically says that if you don't sell an asset during your lifetime and pass away without ever having paid any capital gains taxes on it, then the capital gain gets wiped out, and the person who inherits it is not liable for any of the profit or value that's been attached to that property. So you can have something that you buy, let's say, for $50,000, and if it's worth $1 million, 40 years later, 50 years later, when you die, your loved one or your decedent can inherit it free and clear. You never pay taxes on it, neither do they, right? The only profit that they'd then be liable for capital gains is any that adheres after they inherit it. So capital gains tax, if you can wait it out, never has to be paid, because you can basically pass it on to someone when you die, and they won't have to pay it and you won't have to pay it. This allows families that are already wealthy to basically accumulate significant wealth without tax liability. And in some instances to never pay capital gains tax. And when you consider that for billionaires or for the very rich, most income is in capital gains. That's part of how the rich can basically pay no taxes on most of their wealth. The majority of wealth in the United States is owned by billionaires, is in capital gains, which are not taxed. So we want to understand part of how the very rich are staying rich is simply by hanging on to capital gains which are never taxed, either because they're inherited, balanced against other losses, or something else. Lots of different ways to get tax breaks. The amount of money that billionaires right now are in possession of, which are sheltered in this way, is at this moment at about $2.7 trillion. So if those gains were subject to annual taxes at, say, that 20% maximum rate, which is the most you can possibly charge on a capital gain, it would add about $500 billion or a bit more to the US economy each year. And just to give a frame of reference, this is about twice what the federal government currently spends on education across all systems each year. So just if there were taxes routinely applied to capital gains, not to just the existence of wealth, but to accumulating wealth, to profit being made without an immediate sale, then you would basically be able to add $500 billion to the federal budget each year. And that's just in that one respect. The landscape of inequity in taxation also has to do with subsidies and incentives and credits. So some of us have claimed tax credits on our personal income tax, but substantial tax credits exist for businesses. And one of the things that we see is that there are lots of different tax credits and incentives that corporations are able to claim for doing things which supposedly serve some public purpose. Let's say employing people with disabilities who are underemployed, or locating in a particular area, or something else. But what we see happen in practice is that tax credits sometimes will be created when there's really no extra benefit to the public that accrues. So we can think about, for instance, Disney getting lots and lots of tax credits. Sometimes local and state governments will say, well, we need to offer certain tax credits or incentives to businesses so they'll stay here. But we see those same credits then get applied to places that can't relocate, like airports or like Disneyland, right? You couldn't very well pick up all of Disneyland and move it to another state. You could build another one, but it wouldn't be cost effective to just give up Disney. But we nevertheless will see Disneyland pay almost nothing in income taxes because there's so many credits available to corporations. And we also see other forms of incentives available, things that you can claim against your taxes, for instance, that may or may not continue to benefit the public, or may in concept, but may be given to companies who are not actually providing that benefit to the public. So we see this very complex tax system with new elements always being added to it by Congress and at the state level by state legislatures, so that it can be hard to follow by somebody who's not essentially a tax attorney. And what it amounts to is that once you have enough wealth, the tax systems, generally at state and federal levels, have enough breaks built into them that with a savvy accountant, you can avoid most tax liability. So today in the United States, we've been hearing lots of public debate about wealth taxes, about whether the Biden administration's current social safety net package can be paid for by taxing corporations, or whether that initiative won't make it through the Senate unless they find some other way to fund it. So we find these different ways in which the question of taxes disproportionately benefiting, the fact of taxes disproportionately benefiting the wealthy, basically being a persistent dynamic and basis for calls for both contention and change. So one of our Zoom audience members is asking, do the very wealthy have to pay estate taxes, or don't the very wealthy have to pay estate taxes? And sure, what we're talking about here are capital gains taxes, which are a different category. So estate taxes are not taxes on the profit made, they're just taxes on the overall value, and we all have to pay them. And there are, I wouldn't even try to go over them today, but there are estate tax loopholes as well. We should also note that capital gains taxes are generally not applied to homes in any case, right? Estate taxes are a different category. So I wanted to share a book recommendation by Dorothy A. Brown. I didn't get to talk more about the ways in which racial disparities in taxation play out. We've heard something on the news lately about, or I have at least heard something on the news lately about addressing the fact that tax enforcement, IRS audits, disproportionately target lower income people who make mistakes on their taxes rather than going after wealthier tax cheats. But a good person to read about to see how racial disparities are built into tax codes is Dorothy A. Brown, and particularly I recommend her book, The Whiteness of Wealth, How the Tax System Impoverishes Black Americans and How We Can Fix It. That title again is The Whiteness of Wealth, How the Tax System Impoverishes Black Americans and How We Can Fix It by Dorothy A. Brown. And again, I want to invite everybody to join us again next weekend for episode 37 of the Civics Project on the minimum wage, and on Sunday the 14th for episode 38 on the Violence Against Women Act. Thank you so much, everybody, for tuning in. And for those of you in our live Zoom audience, we'll have time for Q&A and commentary after the recording.